Hello students, we are done the theory of IAS 16 and we have seen the provisions of property, plant and equipment and how important it is to know all the provisions and also to remember those provisions when we are solving the numericals. So basically all professional exams including ACCA professional exam that is there, that is professional exam in the sense that I know it is a skill-based exam, but as we are going for a professional setup to become a professional, it is important for you to understand what is required at the examination level is application of all the concepts that we have learned, and that is the skill of the student. And that in those 3 hours you have to recollect the concept, you have to apply the concept in the right way, right? So let us take a few examples, small examples to explain the concepts. I'll start with my Excel. I'm sharing my Excel with you. I suppose you can see it, right? Simple questions I've taken so that the points are explained. So the first one I have taken where we are calculating the cost of an asset. Given is that an aircraft is considered to have the following components. You are given cost and the useful life. Fuselage, $20 million, 20 years. Undercarriage is $5 million, 500 landings. Engines, it is $8 million and 1,600 flying hours. Calculate the depreciation at the end of the first year, in which 150 flights totaling 400 hours were made. Okay. So let us start calculating the total depreciation. So I'm doing it at the side here. Total depreciation to be charged. Starting with fuselage, the cost of which is given to me as $20 million. It's 20 years life of the asset. So what we will do is we'll be dividing, we'll be taking $20 million, dividing by 20 years, that is the life of the asset. So that will give us a depreciation of $1 billion. Okay, it's a amount of $1 million. Second, we take undercarriage. Undercarriage is having a cost of $5 million and it is on the basis of 500 landings. So we will be calculating how many landings have been done. If you see here, total 150 flights were there. Okay, so 150 flights means 150 times we must have landed, right? So I take that $5 million divided by, multiplied by 150 divided by total number, that is 500 landings. So when I do this, I'll get $1.5 million. Okay. Next is engines. Engines are having a cost of $8 million, 1,600 flying hours. So there have been how many flying hours in the year? 400. So 400 out of 1,600. Okay. So $8 million into 400 by 1,600. So that comes to $2 million. $4.5 million. So that is your total depreciation. Okay. So this is how we calculate the total depreciation to be charged, because each component of the asset, as we said, each component is different, having a different lifespan, having a different method of calculating the lifespan. One is in years, one is in number of landings, one is on the basis of number of flying hours, right? Let us take another example. We have question number 2 here. On 1st January 2086, Z Incorporation has borrowed $1.5 million to finance the production of 2 assets, both of which were expected to take a year to build. Work started during 2086. The loan facility was drawn and incurred on 1st January 2086 and was utilized as follows. 1st January 2086 for alpha, $250,000, for beta, $500,000, and on 1st July, $250,000 for alpha and $500,000 for beta. The total amount is $500,000 for alpha and $1 million for beta. The loan rate was 9%, and the company can invest surplus funds at 7%. So, rate of the loan is given to you as 9%. And the surplus funds investment rate is given to you. Okay, that is 7%. So 7% being the investment rate and 9% being the rate of interest that you are supposed to pay on the loan, right? Sorry, 9% is the rate of interest payable on the loan, and 7% is the rate of interest that you are supposed to pay or supposed to receive rather on the investments that you are going to make. Okay, that is in case you are making the investments, surplus funds. What is required? Ignoring compound interest, calculate the borrowing cost, which may be capitalized for each of the assets, and consequently the cost of each asset as on 31st December 2086. So first let us calculate. See, to calculate the cost, I require the borrowing cost also, because that is a part of the cost. So first let me calculate the borrowing cost. Okay. So we start with the calculation of borrowing cost. How to calculate now? I have 2 assets, alpha and beta. Okay. 2 assets, alpha and beta. Borrowing cost at 9%. Now, 9% of the total amount of loan spent on alpha, that is $500,000. Okay. And 9% on the total amount spent for beta, that is $1 million. So 9% of $500,000 comes to 45,000 here. 9% of $1 million. 9% of $1 million, that is 90,000 for beta. This is the actual borrowing cost. But what has happened is this 500,000 for alpha has not been utilized since 1st January. उसमें क्या हुआ है? For 1st January, we are making use of the amount, some part, that is 50% of the amount. So out of 500, we are making use of 250,000 from 1st January. Correct? and the remaining we are using for the remaining 6 months. So what is going to happen here is we are investing this amount of $250,000 of alpha, and we are investing it for 6 months, because from 1st January up to 1st July, I am not utilizing these amounts. So I will be investing them and I will be getting some returns on them. So when I get the returns, I will be getting the returns at 7%. Surplus funds are invested at 7%. Okay. So I will be getting interest. So I said minus interest on surplus funds invested. Surplus funds invested for 6 months at 7% interest. So now it will be 7% of 2,50,000, that is 250,000. 7% of 250,000 for 6 months. For full year it is 17,500. For 6 months that will come to 8,750. So minus that amount of 8,750. Okay. Next I have 7% interest for the amount of $500,000. So $500,000 into 7%, and for 6 months it will be 17,500. So this will be 17,500. I take the balance, simple calculation. इसको balance लेते हैं, इसका balance लेते हैं. So these figures now are the actual figures that need to be capitalized. Okay. So this is your borrowing cost. This is your borrowing cost. 36,250 and 72,500. Now what I'll do here is I'll write here borrowing cost to be capitalized. Borrowing cost to be capitalized. Okay. So what is the cost of the asset? So let us calculate cost of the asset. So I'll maintain this in alpha and beta. Cost of the asset, construction price. Construction price 5 million and 10 million. Sorry, 500,000 and 1 million. Okay. Add to that borrowing cost to be capitalized. Borrowing cost to be capitalized. That is 36,250 and 72,500. So we'll take the total. So this will be a cost of asset. So we are having now, why did I reduce the interest on surplus funds invested? If you recollect, I had told you that interest will be will cease to exist if I find that the amount of funds are invested somewhere else, and as a result they are not being utilized for the business purpose. Then in that case we are going to we are going to ensure that that amount is not included. So whatever interest we are receiving, we are not going to show that amount, right? So for 6 months, we have not invested a part of the amount. So for 6 months, we have invested and received the interest on that. So we have to deduct the amount proportionately. Fine. Any questions? Anything that you want to ask? So if you are having any doubts, you can please ask me, because you should not go home with a doubt in the mind. All your questions, all your doubts should be solved. And the basic purpose of conducting this revision is to ensure that all your small doubts which arise, small questions that arise in your mind, that should not be there when you're going for the exam, right? So anything that you have, you can ask. Yes, why it is calculated for 6 months. So it is calculated for 6 months because we are investing the amount from 1st January. See, half the amount has been utilized from beginning to end. The remaining half has been utilized only for the last 6 months. So for the first 6 months from 1st Jan up to 1st of July, we have made use of what? We have made use of only the half the amount. So the remaining half has been invested outside, and we are getting the interest on that. We are receiving interest on that. So to the extent we are receiving the interest on the investment, we deduct that. Okay? Because it's not, it is reducing our cost now. When we are receiving interest, our cost is being reduced. Correct? Anything else? Fine. So let us go to the next question. The question looks very big. Sometimes, many times in the examination, it happens that you look at a question and say, oh God, this is such a big question, it will take a lot of time to solve, and you pass it for the future. So future in the sense that you will come back to it at a later stage. But actually, if you go to see, it hardly takes any time to solve the problem, right? So just let us go through the question and see what is the question all about. A company had the following loans in place at the beginning and end of 20x6. 1st January and 31st December. 10% bank loan repayable in 20x8. We have $120 million at the beginning and $120 million at the end of 20x6. 9.5% bank loan repayable in 20x9. $80 million beginning and $80 million at the end. Then 8.9% debenture repayable in 20x7. Okay, that is taken on, I think, 31st December 20x6, because as on the opening date it was not. The 8.9% debentures was issued to fund the construction of a qualifying asset, that is a piece of mining equipment, construction of which began on 1st July 20x6. Okay, that is the first thing. On 1st January 20x6, the company began construction of a qualifying asset, which was a piece of machinery for a hydroelectric plant using existing borrowings. Guys, please pay attention. What happens is, the problem is a little bit, tricky. It is big. Solution is very small. The problem is tricky. Expenditure, you can see that I've underlined this, using existing borrowings. One more thing I want to underline here, in addition to that, is on 1st January 2086, began construction of qualifying asset. Expenditure drawn for the construction was $30 million on 1st January 2086 and $20 million on 1st October 2086. required, calculate the borrowing cost that can be capitalized for the hydroelectric plant. First of all, just tell me as to which amount of loans are going to be used for the construction of the qualifying asset. Are we going to make use of all the loans, or only the first $120 million, or only the second $80 million? Okay, or it is a combination of 120 plus 1 plus 80, or a combination of 80 plus 150, or a combination of 120 and 150, or a combination of 120 plus 80 plus 150. See, we all agree that it is not one particular amount which is going to be used as a financing part for me. I'm going to make use of a combination of loans. What combination of loans? Is it 120 plus 80, 120 plus 150, only 120, or 80 plus 150? You can put your answer in the chat box. Good. Different students are giving different answers. So variety is the spice of life. You know, two things I've underlined. Only two students have given me the correct answer. I've underlined two things only. 1st January 2026 is the date of starting the construction, and they have very clearly given began construction of a qualifying asset using existing borrowings. Acha, existing as on what date? As on 1st January. 1st January, the console loan existing at 120 plus 1 plus 80. 120 plus 80. Only two loans are currently being used on 1st January. So it's a combination of 120 and 80. Irrespective of whether you are using 30 million on 1st January and 20 million on 1st October. But they have said what? Using existing borrowings as on 1st January 2026. So existing borrowings are 120 and 80. That is $200,000, $200 million. So we are concerned with this part. $200 million. So we have to calculate weighted average cost of interest. Okay. So let us work out the borrowed funds to be capitalized, borrowed cost to be capitalized. Borrowing cost to be capitalized. Okay, borrowing cost to be capitalized. First we'll write, since it is a combination of two loans, the rate of interest applicable, would be the weighted average interest. Weighted average interest rate. Okay. So let us calculate weighted average rate. Weighted average rate is equal. How to calculate? First loan is having a rate of interest of 10%. 10% on 120 divided by $200 million. Okay, 10% of 120 divided by $200 million plus second rate of interest. Second rate of interest is 9.5% of 80. Okay, 9.5%. 9.5% of 80 divided by 200 million dollars. So the first one, 120 by 200 into 10%. That is 12 divided by 200 is 6%. 6% plus 80 into 9.5% divided by 200 is 3.8. Sorry, this is coming to how much? 12 divided by 200%. 0.06 and 9.5% multiplied by 80 divided by 200, that is 0.038. So I'm getting 0.098. That is equal to 9.8%. So the weighted average rate is 9.8%. Borrowing cost. Borrowing cost is equal to what we have done. Now let us take the dates. Borrowing cost $30 million for the entire year at 9.8%. $20 million for October, November, December, 3 months. For 3 months, right? So 9.8% of $30 million. 9.8% of $30 million plus 9.8% of $20 million for 3 months. So borrowing cost equals to $30 million का 9.8% is 2.94 plus $20 million का 9.8% for 3 months, 0.49. So 0.49 plus 2.94, that equals to $3.43 million. Okay, just check. First, what we do, we calculate the weighted average rate. And as I told you, problem was very big, looking very big, but answer is so small. Problem was looking very big, and it was tricky also because they gave you 3 loans. You are not supposed to look at this figure. You are supposed to look at 1st January, because they had given that on 1st January, the construction has started. And they had made use of existing borrowings. So on 1st January, existing borrowings, only 2 borrowings were 120 and 80, right? Any difficulty with this? All clear? Fine. So like this, you will be getting very simple questions, but simple questions in the sense that they are a little bit tricky, and they are having this small adjustment which is there, which is going to be creating a problem if you don't read properly, if you don't mark properly, right? So it is going to be a little bit difficult for you to answer, and you may get problems wrong. So that is why in the examination, see that you are reading the question slowly, carefully, not slowly, then carefully. So at least you have to be careful in reading and highlight the question ka important points, so that you know that this is the catch. This is the point where we are going to fall prey to the exam. So always ensure that it is not going to be your mistake in the examination that brings you downfall. Be very careful, be very alert. Right? So this type of questions we will be doing more in the next session. Fine? Any difficulty? Up till here, I suppose there is no issue.